vibe.
I was hungry. I didn't have a big enough breakfast.
Okay, Caleb, we can start.
Here's a question. Can you have too much cash?
Brian, I am so excited that we get to answer that question. As a matter of fact, I am so excited that we get to answer all kinds of questions that you guys have. It's what we love doing here on Tuesday morning. So if you have a question, we would love for you to get that in the live chat right now. We have the team out in the wings collecting them all. So if you want us to speak to something that you care about, make sure you get that question in there. And with that, I'm going to throw it over to you, Creative Director Reby.
Yeah, we're going to kick it off with Craig's question. He says, can we have too much cash? My wife and I were saving for a new home, but decided to stay in our starter home for now instead. We have a large amount in cash now, but we like the added security and flexibility to use it how we want to, home renovations, vacations, etc. If we're saving and investing 25% for retirement, is there anything wrong with keeping this big pot of cash? What do you think?
So, Craig, I love hearing that you are saving and investing 25%. That was gonna be like the big first thing that I was going to ask you. Since you're doing that, I feel pretty good about where you are. But when it comes to holding cash, I think the conversation that you have to have with yourself is an opportunity cost conversation. Okay, I've got the cash and it was going to be used for the down payment for another house, but instead, I now have it just sitting there. And right now, interest rates are pretty strong. It's earning 5%. But when I think about all of the soldiers in my army of dollar bills, are those soldiers being utilized in the most effective manner possible? Because I don't know how old you are, Craig, but here's what I would encourage you to do. If you've not done this, go to moneyguy.com/resources. We have a wealth multiplier tool out there where you can actually put in your age and you can drop in the amount of the cash that you're holding or some portion of that. And you can see, based on your wealth multiplier, what that can turn into by the time you turn 65. And so then the question becomes, what is more valuable? Those dollars working for me, growing towards the future, or the comfort and flexibility of having this pseudo slush fund that kind of gives me peace of mind as I make consumption decisions right now?
When I heard Craig's question, I immediately the question that popped in my head was, what is the why? And let me clarify. If you go to moneyguy.com/resources, you can download the financial order of operations. Cash is such an important step that it actually gets two in the financial order of operations. Highest deductible covered. We've got emergency reserve step 4, which is traditionally like 3 to 6 months unless you're in retirement. It could be up as big as 18 to even 36 months, depending upon your why and your goals and your needs. But we also talk about, when I even covered this in Millionaire Mission, the book, I talk about how cash can actually be a step 8 thing where you're building it for, this is essentially powder money, like Warren Buffett uses it to take advantage when everybody else is fearful. You get to go out there and take advantage of all that great intrinsic value that's just waiting to be sopped up with a biscuit, essentially. But it's for you, Craig. The thing I was immediately drawn to is that y'all chose not to buy a house yet. So, is the house still potentially on the horizon, maybe 2 years in the future, 3 years in the future? If the answer is yes, then the why for your cash is still for the house. You probably need to keep it somewhat liquid and earmark it for that purpose. If the why is, no, this is money that in addition to the 25%, I think I might be retiring early. Maybe I want to leave the workforce in my 50s. Or even late 40s, you choose. You're the person that drives this choose your own adventure that we're on here. But if the answer is you need this for an early retirement, then your savings rate might need to be beyond 25%, and you need to plan accordingly. And that might mean you need to figure out how much of this money should be put back into the investment so that your army of dollar bills can work harder than you can, that with your back, your brain, and even your hands. That is, I would go through that exercise of figuring out what the why is. And then once you have that clarified, you can know if it's okay to keep this extra cash or if you need to redeploy it. The big thing, I don't mind if it's going towards consumption. but consumption should be something that just doesn't happen just because, the money's laying around, because Americans are good at that. That happens all the time. I want the consumption to be kind of deliberate, meaning you've checked all the other boxes and now you can just live your best life.
And it sounds like, Brian, you're saying it's not an all or nothing. It's not I have to either invest all the cash, or I have to leave it all in cash. There probably is some middle of the road approach, again, based on the answer to those questions you laid out, right?
Yep. So what is your why?
Love it, Craig.
Fantastic. Well, Craig, thanks for the question. Thanks for being here. It's always awesome to see what's coming in and see what you all are thinking about. We have another cash question, but more towards retirement from S. Tom that got submitted. It says, I am on step 7 of the FOO. I have $375K in CDs and high yield savings. I retire from the military in 4 years unless promoted, at which point I plan to pay cash for a $500K home. Should I invest my cash? So similar, but different situation, because he has the 4-year timeline and some goals. What would you say to S. Tom?
It was 4 years, not 3 years? I want to make sure I heard it right.
He said 4 years until
4
he
years.
retires from the military, unless promoted. There was that caveat.
He said 4 years till he retires. I'm assuming that what we are going to operate under here is the idea that when he retires, he's going to buy the house. And he said he's going to buy how much of a house?
$500K.
$500,000 house. He currently has $375,000. So he's got, 4 years to close the gap on being able to save an additional $125,000, assuming that this does not include his emergency fund, assuming that this is outside of what he would have for emergency expenses. Here's my opinion, and I'll be curious if you agree with this. If you know the number that is going to be required for you to buy the house and pay for it in cash, and you know where you are now, even though 4 years seems like a long time, I'm going to argue that's relatively short term. And it's certainly a finite timeline if you know that's going to happen. What I would hate to see happen is all of a sudden you say, you know what, I'm going to invest these dollars. I'm going to get them working for me. And man, right there in the 6, 8, 10, 12, 14, 16 months leading up to you needing the cash to be able to buy the house, all of a sudden, that's when we start to see some market weakness. That's when we start to enter into the next downturn. That's when we see a 20% pullback. And all of a sudden, that $500,000 that you needed to be able to buy the house is not there readily available for you just because of market circumstances. So my opinion is, I think putting them in CDs is great. CDs are paying relatively high rates right now. You could even potentially, if you're nervous about rates falling, you could lock in longer term CDs between now and that 4-year period. But I do not think that this money should be invested, since it is a finite timeline. It's not yet fully funded. Agree, disagree, want to fight?
Well, I think we need more information, and the fact that, because Tom left this pretty open. I love that he's in step 7 of the financial order of operations. And I remind you guys, go to moneyguy.com/resources, download your free copy, because what step 7 is, that hyper accumulation stage, is where instead of, you think about steps 1 through 6, you're building your financial foundation. You're also taking advantage of all the tax benefits that are out there. It's kind of streamlined to maximize all those opportunities. Step 7 is that first step where you're thinking about, yes, now that I'm at this point of saving and investing for the future, how am I actually going to use this money? And that's exactly, you're in the perfect place, Tom, to kind of figure this out. But step 7 is, you're trying to figure out, because you said something. You said, I'm going to retire from the military. When I hear that, that means that I'm assuming you've hit the 20-year mark at least. So you have a little bit of homework to do. You first need to figure out, okay, with the pension I'll get from the military, where I'm going to live, what does my retirement look like? Am I ahead of the curve, behind the curve, or right where I need to be? Because instead of you paying cash for the house, you might need to only put down 20% and then fortify your investments, but so that you actually do reach all those retirement goals that you have. Now, if you do the exercise and you realize, I've got this great pension that's going to be coming in, it's going to be more money coming in, plus the job or whatever I'm doing, with my time after I leave the military, I'm going to be fat and happy. I'm post 45, so my army of dollars are just not exponentially growing because of compounding growth and the opportunity cost of that as much as they would have been. Then let's pay cash for the house. But don't just assume. I have a client right now that's been struggling through an employment issue, and we have a meeting coming up in the next few days, and I know it's a struggle, but there's this psychological thing where they're like, we just need to pay off our mortgage because my life would be so much better if I had this paid off mortgage. But the thing is, I know that mortgage rate is right at 3%.
Super low.
And I know, triage wise, there's a lot bigger things we need to be working through. But the psychological thing that they're thinking is I'll just pay off this mortgage. Make sure you're doing the actual two parts of it. Yes, there's a psychological component of the happiness of paying off your house or living in a debt-free house, but make sure the math also supports that so you don't get yourself in a situation where the bridge that's going to actually fund your future or the things that's going to make your life as stress-free as possible, if you dump that into the paid-for house prematurely, you might be surprised to find out it's not everything you thought it was if you need that money to sustain you, to provide for your retirement. So don't skip that. It sounds like you're going to be in a great place because you have this pension coming in, but just make sure you do the work. This is exactly the case study of why we came up with the course and the tool of Know Your Number. If you go to learn.moneyguy.com, you can actually figure out and do the exercise to figure out you're ahead of the curve, behind the curve, are right where you need to be so you can maximize that step 7 of the financial order of operations.
It's great.
Fantastic. Well, Tom, thank you for the question. G- has submitted a question for you guys. It says, I have freed up an extra $700 a month to pay off $30K at 3.9% on a car. Is it better to make an extra $700 payment each month or save in a high-yield savings account at 4.5% until I have enough to pay it off? The minimum payment is $580 for 60 months.
There it is. There it is. Minimum payment, $580 for 60 months. G-Dash, so our opinion is when it comes to buying a car, there's a right way to do it and then there's a wrong way to do it. But there are a few right ways. One of the right ways is just paying cash for a car. A lot of people give us flack because they think that we're saying you always have to go borrow money to finance a car. May it never be. That's not the case. We love if you can pay cash for an automobile, but absent your ability to do that, if you do have to go finance a car, we think there is a really, really good way to do that, and that's 23/8. And when we say 23/8, we want you to put 20% down on the car. We don't want you to finance it for any more than 3 years or 36 months. And the car payment cannot exceed 8% of your monthly gross income.
And Corolla, not Land Cruiser.
And Corolla, not Land Cruiser. And so when we hear that you have financed this car for 60 months, that immediately kind of makes, it kind of gets us a little out there. So I love that you said you did something. You said, hey, I've trimmed my budget. I've really whittled it down. And so now I have this $700 extra a month that I can do something with. I can either aggressively pay down the car, or I could put it in a high yield savings account, making 4.5%, since I know that the interest rate on the loan is only 3.9%. I think, and I'm curious to know if you agree with this, I don't think this has to be an either or. This is what I would love to see G-Dash do, Brian. I'd love to see G-Dash figure out, okay, from the time that I originally bought the car to 36 months in the future, what would that payment be? Would it require all $700 extra dollars, so I'm making a $1,280 car payment, or might it be a $900 car payment or $1,000, whatever that number may be, so that I can get it paid off inside of that 36-month window? Because it is true, at 4.5% on a savings account, you could be getting 5, versus 3.9 on auto loan. I do like the idea of taking advantage of that arbitrage, but not to the extent that it breaks 23/8. You agree with that strategy, or do you think
No,
differently?
I immediately, the thing that popped in my mind is you got to triage your situation to get this back on track. If you 23/8 is the rule, and if you immediately need to go back and do the math exercise and figure out, is it a lump sum or is it a monthly payment answer to get you back on track? Because you did and it sounds like the payment was $500 a month, 60 months. I think this is going to be something that if you go reverse the math of if you finance this for 36 months, you're going to find out it's going to be part of, this is going to be a twofer. It's going to take a portion of that $700 a month to have this car paid off within the 36 months. But then there's a good chance you're going to have extra money out of that $700, that excess, and you then go back to the financial order of operations and figure out, is that to boost up my cash and reserves, or do I get to get into the exciting stuff of like Roth IRA contributions and other things to actually start building your army of dollar bills?
Love it.
Fantastic. Well, G-Dash, thank you for your question, and I hope that helps.
You know, can I be honest? What I thought was going to happen?
What?
And you didn't do it, but it's okay. Because there was a car buying. You and I had a question about automobiles this morning before.
Oh, you thought I was going to give a rant.
I was like, oh my gosh, she like lobbed up to Brian just red meat for you to jump all over this, even though this wasn't like a luxury car question. Because we had an intro, right? Like I thought that was where this was going to go.
Well, here's the thing. I almost hesitate to share personal stuff like this because we're going to, you know, what is it when you make the same mistake over and over? Is that insanity?
The definition of insanity is doing the same thing.
We're going to do
and
it
expecting
again.
different results.
There we go.
Maybe you're not expecting different results.
Y'all know this awesome luxury European car that my wife has that is now about to be in its 7th year of ownerships because, you know, we're pretty good.
You're financial mutants. You do what you say.
We own them, and it's been paid for years. Well, you know, we live in Tennessee. And right now, somehow, because I was in Florida, you know, for most of last week, somehow Tennessee's hotter than Florida is right now.
Is it really?
Yes, we are hotter than Florida right now. And we have humidity and everything else. So my wife calls me yesterday and says, hey, the AC has gone out in her car, awesome luxury European SUV, and I'm like, oh, I wonder how much this is going to cost to get fixed. So she takes it. Well, of course, when she gets it there, we have to do the AC repair, which they gave us a price, but they said it could be more.
Of course, what they find. Right? Why wouldn't they say that?
Then there's a 60,000 mile warranty service where the supercharger needs a new belt or chain. I don't know. You know, I guess you know when you buy a lot of these new cars, they have timing belts and all these other things. I guess in the European, they do supercharger belts. You know,
so you got belts on top of belts.
Yeah, belt on belt. And then there is also, of course, and it's part of the 60,000 mile is the oil change and everything. So I came in and told Bo, I was like, give me a guess on what you think those 3 services cost. And he told me less than $1,000. I said, this is not a Honda Accord. I said,
I was doing mental math, but I was.
It's extra.
It was more than that.
Yeah,
it was more than that.
So they get you these cars, and then somebody says, you know, this is how they make their money because they don't make a lot on when they sell the car. And then Bo and I were very quick to correct them. I said, I think they get you on all angles on these cars. They get it on the service. They get it on the. And by the way, and just so y'all are like, Brian, you're a financial mutant. Just take it down to the guy down the street that will do it for half the cost. Here's where this luxury automaker gets you. I did that because I was so frustrated with this auto company that I was like, you're not getting another cent from my pocket. So I went to the local place to get the brake pads done, and they quickly called me up and says, Mr. Preston, unfortunately, this manufacturer is structured that the only place you can get parts is directly from them. The brake pads, and I was like, oh my gosh, is that how much brake pads cost? And then, by the way, I found out that there's this whole recall or lawsuit about the brakes for this car. If you went through the dealership, they did 100% reimbursement. If you went to a third-party service place, you only got a 50% reimbursement.
So they forced your hand.
So I've realized, no, if you're going to get service, you need to go get ripped off so that when they get sued by somebody for all their bad practices, you at least get all the money back versus half the money back. Look, at some point you just realize you shouldn't be buying these, but
yet here we
are.
The
happiness of my wife makes it's good to be a financial mutant and be beyond, you know, in steps 8 and 9 that you pay this premium to keep your spouse happy.
Well, look, Raby, I got it in there anyways. I got
you
the
did.
little extra thing in there.
He was like, oh, let me tell you.
Oh, it's so good.
Yeah, it does. I mean, thank goodness she doesn't watch the show.
If you're out there,
all right, we know.
Mrs. Preston.
Yes.
Sorry about railing on your car.
No, hey, she loves her car.
Oh, no,
like
she wants a new one now at this point, but I'm like, nah, this is not a 2024 decision.
She thinking Corolla?
No. I was like, can we just go to a Lexus dealership? And I was like, just buy anything from this Lexus dealership that you want, because I know at least I've had, that Lexus that I drove. I mean, I don't think, besides oil changes, I don't think it ever had any service. It was just so convenient. You know, when you bought it, it had service. That was
we're going down the
look, OCD Bo.
Brian's other car problem.
Okay, we don't even have to get on that.
That's hilarious.
A little oil. Look, a car gets that many miles. It might have a little oil underneath it.
You know what? Here's what.
Oh, bougie Bo don't like a little oil in the garage.
if you like hanging out with us, hearing this kind of stuff, and you're not subscribed to our channel right now, you ought to subscribe so that every time we release new content, you can get notified to know that we have something else coming out for you, because we love doing things like answering questions. And with that, Reby, do you have another question?
I do have another question.
I might. Hang on. I gotta get it. Okay, I can focus again.
Bring that blood pressure.
Yeah, I mean,
down.
I don't know if I'm
good.
red, but
Your
I
wife
get
is
flushed
just
thinking about
awesome,
all this
and I
thing with
get
this
tons
car.
of amusement out of this. But
It
you're
really
fine.
does make
it's
it.
all good.
But y'all know this is gonna be. This is why maybe it's okay that my wife likes these cars, because it creates great content. Because we're gonna do it again.
Yes.
We're gonna make this
It does.
mistake again. We're gonna so do it.
You're fine. It's not even a mistake.
I'm right there with you. Not gonna lie, I'm right there with you.
By
So
the way,
I got one.
The other confession that Bo
It's
let
not
me
a
know.
mistake though, because you followed the foo.
Yep.
You're
But
fine.
here's the thing: like Bo, they have a minivan in their family.
Uh-huh.
But he's let me know that is probably short for the
Well,
world.
because we had like the super nice luxury car, and then we went with the one that's not a luxury but has a luxury price tag on it, and then I finally got to the minivan, and she's like, "Hey, you got me for one. You got me one time." So we'll see what the. That's why I'm gonna hope she drives it for 20 years, and we'll go from there, and we shall see.
We'll see.
And that, truthfully, if a car is going to go 20 years, that's
It's
the
gonna be
vehicle
that
that will
minivan.
do it. So
Those
you
will
got a
go
good
a long
chance.
time,
You
yeah.
got a good chance.
All right. Well, we do have some more questions, so let's dive back in. This one's from Andy's Cool SN. We could just call him Andy. Do you have any recommendations or quick calculations for emergency savings for a rental property? I own a duplex with separate hot water and furnace and AC. Also, how much excited is so excited?
Love it.
Had to throw that in there.
I mean, this is a great question because people ask us this all the time. Hey, I really want to get into real estate. It's something that I'm passionate about. It's something I feel like I have an eye for. Maybe I've fallen backwards into it. I owned a home and then I upgraded and bought a new home, and I'm trying to figure out, how do I do it well? Well, a lot of people think, hey, I've been working through the financial order. Brian, we hold the thing up. I've been doing the financial order of operations, and I got to step 4, and I have a fully funded emergency fund. I have 3 to 6 months of living expenses. So long as I have that, I'm probably covered when it comes to a rental property. Isn't that right? Well, probably not. I think that the answer to Andy's question is, as any good financial advisor will tell you, it depends. It depends on your unique circumstance, but this is what we love to see happen. We love that when someone has a rental property, because we all think about, man, it'd be great if I had a tenant in there and the tenant covers all the costs and then I have free cash flow. But what happens if that tenant's not in there? Or what happens if you go through 2, 3, 4, 5 months of vacancies? I would like to see, Andy, in your situation, you have an emergency fund that can carry the cost of a vacant property for a reasonable enough time for you to get another renter in there. Now, your market will dictate, is that 3 months, 4 months, 5 months, 6 months? Because what you don't want to do is something goes wrong, you have an emergency that happens in the house, and then the renter moves out. And now you literally can't afford to cover the float of that property sitting there vacant. So my opinion, Brian, I'm curious if you agree, when it comes to rental properties, you ought to have a separate emergency fund. And depending on your cash flow, it should probably be somewhere between 3 to 6 months of the float cost for the rental property.
Yeah, here, let's even add a little bit more. This is why I always say residential rental or any rental property is step 8 of the financial order of operations. And part of this, and I want you to treat it like a business, is that, yes, they're probably, you look at your marketplace, figure out how long that places sit vacant. If is it 3 months, is it 6 months, and make sure you have that carry cost covered. But then I want you to go a step further. We did this on our commercial property, is that go look at all your systems. Are you going, how old is the air conditioning unit? Is that, what's your maximum exposure if you had to replace that AC? How about your hot water heater? Go through all the different systems on the house and try to come up with a quick schedule of when it's going to need to be replaced, and then just plan accordingly, because things happen. Like especially if you're like on a septic tank, if this is out in the country someplace and not on sewer, that's expensive too. I mean, and these things, find out when the last time that was cleaned out. These are all things that you should do as part of the due diligence of getting into residential rental and treating it like a business so that you don't get caught flat-footed, because yeah, it can be great. It really can, but even great investments are going to require some work, and they're going to require some capital to keep them humming and working when you have these things pop up.
I think it's interesting because you've prepared, in your previous life, you prepared taxes a ton, and I think we get a bad rap because people assume that we do not like rental properties. We don't like residential rental, but that's not true, because you've seen tons of people who have done it successfully, but you've also seen people who have cut that margin way too thin and got themselves in trouble, right?
Yeah, what it typically, where I saw it, recognize, I've been doing this long enough that I got to go through the Great Recession and then the aftermath of that, and there's so many people who are trying to scale with residential rental. Where I had a gentleman who was very successful in a financial sector, and he got into residential rental, and I think he was up to 45, 50 homes.
That sounds wild.
I know, and these were low price point homes, and it was working. I mean, on paper, he was worth a lot of money pre the Great Recession. But then the problem happened when we hit the Great Recession, because the problem with leveraged debt is that when the people quit paying rent, and then all of a sudden the people started tearing up stuff because they're upset about the economy, they're upset at the landlord, there's just a lot of bad things going on. If you bring all those things together, the lack of rent payments plus people then now tearing up these things, and then the banks being in a position now where they want their money because they're under their own pressure, it created a lot of stress, a lot of hardship, and pretty much came close to breaking this person. And that's why I just tell you, be careful, because you see it all over social media. They'll say, hey, I did a flip, or I did this rental property, and I'm getting cash flowing $1,000 extra a month. This is going to be, if I do this 30 times, I could be making 30 grand a month, because they do the simple math on it. But and I guess in that moment in time, yes, it could, but also do the reverse side of that and say, what happens if you load up and you get all these rental properties and then things just don't go the way they're supposed to? That doesn't mean, because by the way, if you survived it, because let me tell you, I have another client that actually bought all their properties during the Great Recession. Holy cow, their balance sheet of their net worth statement looks incredible. If you think about what they got some of these houses for, what they cash flow now, and now what they, the appreciation from the investment. So it's just making sure that you can weather all storms, so you get to be the positive side of that versus being the one that had to unload all of your properties at the worst of time and break you.
That's great.
Fantastic. All right. We've got another question from Hockey Haloed. It says, this is a funny one, honestly, to me. He says, once you start looking at your personal finances, how do you stop? I find myself more and more distracted by optimization these days. This is a very deep financial mutant question, and I think you guys are the perfect ones to answer it. What do you have to say?
Well, I'll speak for me personally, right? One of the things that I do, Hockey, is I do an annual net worth statement. And when I say annual, I mean literally one time a year I do my net worth statement. It's always on 12/31 or thereabouts at the end of the year. Because I recognize my personality, being a financial mutant, loving this stuff so much. If I were tracking this stuff on a weekly or a monthly or a quarterly basis, I would literally allow it to drive me nuts. And so purposefully, I try to not ignore it, because I focus on my behavior. I focus on the things I can control, my savings rate and my allocation and my tax strategy and the fees that I pay and those types of things. I focus on my behavior, but the outcome, I try to let myself, quote unquote, be surprised by at the end of every year, so that I'm not focusing on the little stuff. I'm not majoring in the minors. I'm keeping an eye on the big picture. That's one of the ways that I stay not dialed in and not laser focused and lose sight of the forest for the trees.
I've made this analogy before, but I think it works out quite nicely, is that I think about when you discover personal finances, it in a lot of ways, and we'll make the analogy and tie it into doing the net worth statement. It's like having, a newborn baby. And the fact that, now, where I'm going with this is that, look, in the beginning, your finances are going to need a ton of attention. You need to be getting those affirming things of like, pay attention to your finances, look at them weekly, look at them monthly, because you need to be in there to kind of, you're doing all the triage to fix your situation. You're listening to our content. You're going through the financial order of operations. You're trying to absorb as much information that you possibly can. I think that's completely healthy. Plus, because I remember for me, when I first discovered, I still remember in the mid-90s when I got the Millionaire Next Door, the Wealthy Barber, and I was like, holy cow, I feel like somebody has just opened up my brain and shown me the path. And I'm hoping that's what Millionaire Mission and the Money Guy Show, we're doing that for you guys too. So I want you to be energized and excited. And I want you, because you're, like you said, you're in that infant stage where you can't stand on your own yet. You need a lot of attention. But you will notice if you start making the right steps, you start learning the right things, you start automating the process, there's going to be less and less you're actually adding value by tinkering. And that's why I do think you graduate from updating your net worth statement and doing things within your personal finances weekly to maybe it turns into monthly and then it turns into quarterly. And then hopefully you get to a graduation point, kind of like where Bo is now, where you still need to be giving it attention, but you just don't have to do it as much because now your money and your army of dollar bills are then not only, feeding themselves and taking care of their personal hygiene on their own and bathing themselves. They're actually now graduating high school, going to college, and maybe once a year is still necessary so you can give them the old pep talk, your personal finances pep talk, but it should be doing everything on its own at that point because you automated the behavior. You focused on the good steps, and it allows you, that's why we gave you the financial order of operations and share all this, is because I'm hoping by the time you get to step 8 of the financial order of operations and you get to abundance goals and you start thinking about what is the why and how am I going to use this money, it's a much more mature and focused thing that from an abundance standpoint than when you're having to just think about your money as how it covers your bills, because that takes away your ability to focus on owning your time, focus on what the purpose, because you're just trying to survive and cover. And that's why I think it's perfectly fine, Hockey, to be hyper-focused on it in the beginning because you're trying to affirm those good behaviors and those habits. But just know thyself to where you can graduate to where it stays on the healthy side of things and you're not alienating your friends, your loved ones to the point that you're over-focused and not thinking about what money can and cannot do.
I'm curious, Megan, can you do a poll for me? If I ask you for a poll, can you do it? I want to know, like, our audience, how frequently are they doing net worth statements? And let's do it like this. Do you do it annually, more frequently than annually, or what's a net worth statement, right? Because I think it's an interesting to see what our financial mutants do. The other thing, as you were talking, Brian, because what Hockey said is I'm so focused on optimization. I've started paying attention. I'm so focused. You have to make sure is the juice worth the squeeze?
The hassle factor.
Is it? Because I was sitting here thinking, like high yield. Oh my! Right now I've got a high yield account paying 4.5%, but man, I saw another that was like 4.55. If you're spending a whole lot of time trying to go grab that, unless you're holding like an egregious amount of cash, I don't know if it's worth it. I put credit card rewards. Are you someone who every 2 weeks you're applying for a new credit card, you're rotating your categories? Well, when you actually look at the benefits you're receiving, is it worth it? Are you getting a ton of benefit for that? And then the third one I put was taxes. Are you someone who every time you're writing down the miles every time you get out of your car and you're tracking every single receipt for every single thing that you buy? Well, that can be valuable, and there's certainly
some of that you have to do.
Some of that. Well, I'm making the suggestion that if you're so laser focused on these like minuscule things, I would really ask myself, am I really optimizing, or is me trying to optimize actually causing me to be suboptimal? Because I am focusing on the little things that don't have big impact instead of the big things that have significant impact. As you were talking, that was what's kind of like ruminating through my mind.
It's back to, because I have shared on this show before that I had a dear friend that their marriage was under a lot of pressure because he just was too tight, requiring the spouse to give every copy of every receipt and transaction. And that was just too much. Once you get to a point of there's nothing wrong when you're in the beginning stages where you need discipline and accountability for you guys to be, especially with your spouse, y'all be on the same page and you have this common goal, but there can go too far when you've kind of built an automated wealth building strategy. Why are you still hyper focused on that? It's just not worth the hassle and the damage it does to relationships.
Awesome. As these answers are rolling in, I see that about 8% of folks say, what is a net worth statement? If you want to go to moneyguy.com/resources, you can check out sort of our little free deal. But if you want to get like the real deal net worth tool, I'd go to learn.moneyguy.com, and we'll actually walk you through how to do a net worth statement, what information is valuable, and what should you be tracking. If you're one of those 9% that don't know about that, that's a great place to start. And the best time to do it was yesterday, which means the second best time to start doing it is today.
I get excited knowing that 10% of the people are kind of at the beginning of
I
that
love it.
journey.
Yeah, it's like,
because
welcome.
that means
You're in the right
the
place.
frothiness of you, how much we can load you up with information just gets me excited to know that we are still attracting people. Because probably the biggest criticism I see we get is that since we give you everything, we don't hold back. It's, we kind of load you up. Is after you've been here for a while, some of you are like, well, it's the same stuff. I'm like, yeah, that probably means you're at the graduation point. Go do some action, still check in with us, but let's go make some things happen. Because that's the reviews I see out there on Millionaire Mission and stuff is like, oh, listen to the show already, and this is the same. I'm like, yeah, because that's
You're part of the tribe,
I
man.
didn't change the whole formula just so I could sell you a book.
Yep.
Absolutely. All right. Are you ready for the next question?
Yes, ma'am.
We have Sam's question next. It says, I recently bought a house at 6.99%. As I hope for interest rates to drop, can you explain a refinance versus a loan modification? Loan modification seems to be the way to go, he says, but what do you think?
Oh man, I love this question so much. Matter of fact, we love housing questions so much that we've actually dedicated an entire section of our website at moneyguy.com to housing. Like, how do I know how much house can I afford? We have a calculator there. Or when it comes to buying a house, how do I know the things that I'm supposed to do? Go check out our house buying checklist. All of that is available out there because a lot of the things that we speak to are questions like this. Hey, I heard somebody say something about like a rate modification, and we actually do content on this kind of stuff. So if you're not subscribed, make sure you subscribe because as rates drop, I'm sure we'll be talking about this more. But one of the common things that people do is they say, I'm going to go refi. I'm going to go refi. And one of the first questions we always tell someone is, hey, before you refi, before you do a refinance, there might be another step that you ought to go do.
Yeah, this question was phrased in a way by Sam that it said, what's the difference between loan modification, or what we call rate modification, versus a refinance? I'll tell you, I wouldn't do this as a versus. I would say that this is a loan or rate modification should be part of your refinance journey, is because, yes, rates are going to be coming down. All indications are potentially 0.5% in the next month. So you'll start seeing some direct impact on that with your mortgages, your credit cards, and all kind of other things out there. So the first thing I would do is you look to find, you call your lender who holds your mortgage, and before you start the refinance process, and you call them up and ask them, say, hey, look, rates are coming down. My mortgage rate is now, 0.5%, 1% greater than where the market is. Can you do a rate modification? Their initial answer might be no, but I wouldn't stop there. But I would ask a question. I'd be like, look, if you say no, I'm potentially going to move my business I'm going to refinance this loan. And if you have other accounts with them, you could even use that as a part of the bargaining position. But you should, at a minimum, any refinance, you should call your current lender and just ask them if they offer rate modifications. It's easiest. I've seen it especially with like credit unions. If you have your mortgage held by a credit union and others, I know for a fact that they'd rather keep your business than just watching it walk out the door. So you call. Now, you will get to a situation, especially if you're with a big lender, because I've had this. I call every time I've ever refinanced. I call my existing, and I remember, was it Mr. Cooper who bought out Nation Star or whatever it was, and I asked them. I was like, hey, is this something that I can refinance? Get a rate modification? They're like, no way, no how. And they were serious. You could tell, the person understood what I was asking for, but it's just their policy was they'd rather make you go through the process of refinancing. So if that's the case, then you have to do the math of, should I refinance? And this is the thing that we're going to get into a strange dance here. As rates start to drop, when do you pull the trigger on the refinance? And that's why when it gets around a 1% drop from what you're paying versus you need to then look into and see if you can do prepaid costs so you don't have to pay anything for the refinance. There's all kind of other things. We're going to be creating more content.
Yep.
We even have, that's why I would lean into what Bo said. Go to moneyguy.com/resources. We already have some deliverables and resources on refinancing, on home buying. All that stuff's out there, but don't just jump into a refinance. Call your current mortgage company to see if they can do a rate modification. Here's how I love this story. Last time this was a big issue, I said it, and then I have a close friend down in Georgia. I was on a trip, a golf trip, and he goes, I check in on your content from time to time. He goes, dude, you saved me so much money with that tip. He's never heard of a rate modification. Yep. I called my bank. They wanted to keep my business, and they were able to drop my rate. And sometimes it's okay. They might even charge you $1,000 or something.
I was going to say in my experience, it was a couple $100 relative to the closing of a refinance.
It's a lot
mortgage
cheaper.
Was a lot more, and the paperwork was a lot less. I mean, it was like I called my mortgage company a couple of years ago and said, "Hey, I'd love to do this." Said, "Okay, great. Here's the application." It was like a 2-page application, cost me a couple $100, and it dropped my rate by like 0.25% or something like that at the time. So it's fascinating how much different those two processes are.
Well, it doesn't have to go through the whole, because the problem with refinancing, if you think about it, it's an expensive transaction because you have to get attorneys involved. It's got recordings with the local governments. There's just a lot of moving parts because you're basically ending one loan and starting a new. So all the recording fees, all the title stuff, all that stuff just has to go through its process. So it's expensive. Whereas a rate modification is basically just the bank saying, you know what, we want to keep your business. So internally, we're going to make you fill out this application, pay these few $100 just to keep your business and lower your rate.
It's great.
Fantastic. Thanks for the question. Moving on to Aaron's question next.
You say Aaron?
Aaron.
Okay.
Aaron.
Aaron.
He says, I am not planning on retiring before 59 and a half. I don't need a bridge account. Should I continue to max out my Roth IRA, HSA, and not have anything in taxable? I feel like I don't need taxable. Am I missing something?
Yes.
Do tell.
You sound very confident about that.
Look, I have clients that love the tax savings of retirement accounts, but I'm just telling you, you need some taxable holdings just because it's just the easiest access point for not only just paying your living expenses, but also if you come across once in a lifetime investments, it doesn't have the drag that retirement accounts have. Let me put it this way. When you pull money out of tax-deferred accounts, that's your 401ks and other things, you just know you're going to pay ordinary income tax rates. And that hurts because usually those are your higher tax rates. Roth money, yes, you could get access to that. You could even get access to the capital or the initial contributions, probably tax-free. But you're going to find that, especially if you're good with math and numbers, you hate taking money out of Roth because that tax-free growth, there's a reason the government's restricting how much you can put in each year, is because, man, when it hits critical mass, it feels so sweet watching that account grow 10,000, 100,000, whatever it is, depending upon the size, completely tax-free. So you kind of hesitate to want to grab that first too. So that leaves having the taxable so you own your life is what I look at it as. That taxable, I know you say you don't need a bridge account, but man, do I like having a strong emergency reserves and access to capital. And that's what the taxable accounts are going to allow you to do.
I agree with you.
But there's a big but
see,
coming.
Aaron threw this thing on the end. He's like, I'm not going to retire 59 and a half. Should I keep funding Roth and HSA? The thing that's so unique about Roth and HSA, they are those tax-free accounts.
So
right?
you're saying he's much younger and still in the step 5 of the financial order of operations. That's something, I probably just overlooked.
So now I'm thinking is when he's thinking about building a taxable account, is he having to make the decision, I can either put money into Roth and HSA or put it into a taxable account? In that scenario, man, this is where, because I agree with you completely. We're talking about pre-tax accounts. You get retired, it's very expensive to go buy a car. It's going to cost you the car plus the taxes to pull it out. But with Roths and HSAs, those dollars can come out tax-free. And while I agree that they are the most valuable assets you have, you want them to grow as long as possible, In terms of getting them funded, if I'm thinking through beginning to build a taxable bridge account or continue to pile those dollars into the tax-free, I see where Aaron's coming from, because even getting those dollars into the tax-free, when you get to 59.5, there is no tax drag, and hopefully that tax-free bucket is just big enough that, yeah, you're having to pull from it, but I think having those dollars in the accounts and funded would probably be okay in this scenario, so long as you don't, as long as you know that you won't need to leave before 59.5. Now, yes, you can pull out of the Roth basis and that kind of stuff.
You know what fixes all this?
Save more, do more, both.
There's a system.
There it
called
is.
The financial order of operations, because you know what? Step 4 is going to make sure you have enough in that after-tax emergency fund, that you have all the access points that I was talking about. And then I misunderstood. I thought we were beyond, so I missed that part. If Aaron is still in step 5 with the Roth and HSA, yeah, get in there. There's a reason I was just telling you nobody wants to touch that. It's because it's so good. So you need to go take advantage of what the government's offering you. Step 6. Max out your retirement accounts, getting to 25% investment rate at a tax favored way. It's really a step 7, and that's where I was maybe giving you too much credit, Aaron. Is that I thought you were already kind of thinking about how you're going to use this money in retirement. So step 7 is where you think about the 3 buckets, where it's after tax money, the tax deferred money, and then the tax free Roth money. Maybe I skipped a step there. I should have known the foo is your way of what to do with your next dollar.
Love it. Thank
Always
you.
is.
Hey, Ron.
All right. Up next, we've got a question from Mama Didn't Raise No Foo. She says, I have a question I haven't seen on the show before. If you have reached the boiling point or the bowling point, how do you explain to your kids, we're doing okay and not to worry, but also don't let it get to your heads?
Oh, this is where
I know how Shaq does it.
I had two thoughts. I was like, just keep telling your kids. It's okay if your kids don't know you have money. I think that's okay. But then there's so that's one side of it. I do that with my youngest. Like I'm just like, she's like, Dad, someday when we're rich, can we do this? I'm like, yeah, maybe someday we can do that. So maybe it's wrong that I'm playing this game with her. But then there's the Shaq way, where you basically just straight up, and it's probably for Shaq, it's hard for him to hide what he has. I mean, when you got all the Papa John franchises and everything else he's rolling with,
it's hard to hide it.
You just remind your children that, yes, you are rich, but the kids, you're not rich. And that's something just to take into account. And that's why, guys, from the beginning, I've told you, Bo does a great job with the save, spend, give?
Yeah, give, save,
for the
spend.
younger. Go ahead and get those categories into your young children's mindsets. But then I'm one that I love your children working while, getting a job at some point in high school. I even like fast food or food service because it lets you get direct access to the crazy public. As soon as they start working in any type of job that's considered earned income, start doing matching funds and you can open a custodial Roth IRA or something like that. But go ahead and start priming the pump of good behaviors and disciplined behaviors, and also the value of hard work. Because if you can catch that fire young and they see it and they can kind of feel it and actually then catch traction with it, your life is going to be a lot easier, and it's also very fulfilling. As you get to experience the fruit of a child that actually you realize is a good hard worker and good with their money. I mean, I'm feeling that right now with my daughter who's a junior in college, but she is good with money, and it warms my heart to know that.
Yeah, it's really interesting. The question says, how do you explain to your kids we're doing okay and not to worry? I don't know that you have to explain to your kids that you're at the boiling point. I think once you reach critical mass, I don't know that's something you have to tell your kids or walk them through. But what I've tried to model is it's really easy. I've got little kids. It's really easy just to say, oh, that's too much money. That's too expensive. That's whatever. But I do agree at some point, as your kids age and as your kids mature, they're going to probably recognize, oh, okay, things look different. And so what I try to do is I try to always point it back to the behaviors. Hey, girls, the reason we're able to go on this vacation, the reason we're able to have this experience or do this thing is because, mommy and daddy make really specific decisions about how we save. And we've been saving for this. And we've been so it's less tied to the outcome, the success or the wealth or the money or whatever, and much more tied to we can do this because of the behavior. And if you can begin to drill that into your kids, it'll be less about the destination and more about the journey to get there. Because that's what I want them to walk away with, is what your daughter now has. She behaves a certain way because that behavior was modeled for her, not just because she was told, hey, everything's okay, we've got money, we'll be fine. If you can begin to instill that in them, and that just becomes naturally part of it, hey, we can do this because, I think it creates a very different mindset in your children and not an entitled mindset. Now, one of the things you have to combat is when things are perhaps a little bit easier, a little bit smoother, there's more money laying around. I do think you have to be intentional with, I don't want to say creating scarcity. That's the wrong word. But
put scarcity in their life.
Okay, maybe it's the right
I'm
word.
all about some scarcity in some rich kids' life. They don't need to get it all while they're young.
Agreed. But I would say it's really easy to say, oh, we can afford it. It's a much harder thing as a parent to say, oh, no, we can't afford it. We're choosing not to because. And I think when you can begin to introduce that in and help them understand the value of money and the value of decisions that you're making, I think it just changes the whole dynamic. And that's something that we're having, especially in the community in which we live, having to like work through with our kids, even present day.
I mean, I'll say it because I know it seems like nobody listens to me, but I did it with my child, is that I gave her one of those character building cars, a 12, she paid for half of it. And that's what I think that is a good thing. Whereas it seems like all my neighbors were giving our kids brand new cars right out of the gate. I think that's wild. I mean, I think that's if you start what you don't want, if you are living in abundance and you're a financial mutant, you do not want your kids' best days to be while they lived under your household. I mean, think about that. I mean, I want you to internalize that. I want you to give your children, give them a great life, but build them the mindset, build them the life so that when they get to go buy that first car, they know how it feels to buy that first new car. That when and there's nothing wrong with like travel well and do those type of things. I think that's okay to invest in the memories, but do not make your child's best days the days that they were K through 12 in your household. I think that is something that you ought to bear the responsibility and the weight of, so that you can actually create kids that are going to live on their own and be independent and be good working humans after they get outside of your household.
Love it.
Love it. Very good question, Mama Didn't Raise No Food. Thanks for being here. All right. KP's question is up next. He says, hi, Brian. Didn't say hi to Bo. I don't know why. That just struck me as I read it. So this one, I don't know, Bo, you could just sit this one out if you want. Anyway, here's the question. He says, I am new to the financial order of operations and am trying to understand why step 8 comes before step 9. I would have expected these to be flipped. So can you elaborate on the order of these steps and maybe give a little more nuance to it?
Yeah, I mean, this is one, because I just think about your journey. Remember, and I guess I'll have to go from, and this is why I really am proud of myself in Millionaire Mission. If y'all didn't know, I wrote a book.
Did you write a book?
I wrote a book. But step 9, I do 3 graphs where I talk about, when time is restricted versus your income. It's basically earning potential, happiness factor of people by age. And then I lay out, all these things culminate into the fact, and also then how the money wealth multiplier of what the potential of what every dollar can become. And I think when you look at all those things, you realize that mortgage debt is one of those things where a lot of financial talking gurus have misled us in a lot of ways. Is because we're in our poorest of moments. We're also, it's that traditional messy middle where you're short on time, you're short on money, but yet you got kids, you got chaos. You need as much house as you can get just so you can live in that chaos. You need to spread out that house because you need time to let your income catch up to all your earning potential and everything else. So we needed an honest conversation from somebody who kind of laid out all these things where I took into account the time, I took into account the money, I took into account the wealth multiplier and the value of compounding growth. And what I came up with is that for the majority of people out there, I know we're in a unique time right now where interest rates on mortgages are, 6%. I have heard a few go below 6% recently, and I think that's going to start to become the trend again. But you're going to quickly find out that you need rules that let you build in all the life stuff but also allow you to have that nice house to raise your family in. But then you're going to reach step 8, and you're going to say, hey, this is the point where I laid out my financial foundation, and I now need to start funding the kids' college. Or maybe now I'm at the point where there's still some things I want to do for building my wealth, like maybe it's residential rental, maybe it's an investing or building up cash for investment opportunities or other things. But then I laid out in step 9, if you're over 45, because this is going to take a time to go through all these steps of the financial order of operations. Yeah, by all means, I want you to prepay that mortgage to pay it off, because you will have not sacrificed you living your best financial life because you did things out of order. I saw a post last night from somebody, and I see them all over social media right now, where people are they paid off 3% or less mortgages, and they're still trying to tell us how they're all so proud of that decision, that it's not a regret. And I'm like, why do you keep posting this? Yeah. It's almost... And I've told this story where I had a neighbor, he's moved away now, where every time I saw him, he knew what I kind of did. And he'd tell me about how he was doing penny stocks, and he bought Monster Energy before it was Monster Energy, and how he missed out on all this money, but it was okay. And people just tend to I'm just trying to give you the best, where I give you the mindset, I give you the math, so you don't have those regrets where you're posting why it's so awesome that when you were 32 years old, you paid off your mortgage over and over and over, trying to make everybody feel better about the decision you made. I tried to give you the balance to where when you pay it off, you feel completely comfortable about it. And I hope that what would you add to that? Even though KP didn't ask you for your input.
You don't care about my opinion, but I'll never pass up an opportunity to talk. What I think is interesting is that money is nothing more than a tool. It's not a goal. So we have to define what our goals are and how our money can help us get there. What's great about step 7, 8, and 9 of the financial order of operations is this is where goals really come into play. And so you may decide, hey, once I get into the hyperaccumulation phase, once I'm saving more than 25%, one of my goals is to be debt free. And if that's a high priority goal for you, it's okay if you prioritize doing that before you fund other abundance goals. Like maybe you want to be debt free before you save for college, or before you save for that trip, or before you save for whatever. You as the financial mutant, and you as the author of your own financial journey, get to dictate that. What we've tried to lay out in the financial order of operations is the optimal, or the way to maximize your dollars, and that's where the order comes from. But once you get into that final tier, once you get into 7, 8, 9, you control the goals. And if you choose to accelerate step 9 into step 8 or before step 8, that's totally okay. You're at the point in your financial journey where you get to make choices because you want to, not because you have to. We're just trying to lay out for you the optimum solution, optimum strategy.
It's steps 1 through 7 is the make the wealth stages, so we can actually, it's not just guaranteed you're going to be wealthy. The majority of Americans don't ever make that success level. So that's what steps 1 through 7. Steps 8 and 9 are more about maintaining the wealth, because you're de-risking. And then I want you to even go, and I cover this when I go, especially Millionaire Mission, when I went beyond what I do when I talk about my money and other things, as I want you to multiply your wealth too, and build the legacy, do the other things. So that's really the big answer. Steps 1 through 7 is to make the wealth. Steps 8 and 9 are to maintain the wealth. And then I'm hoping this entire journey, what you're doing with the Money Guy show, is going to help you multiply the wealth.
That's great.
Beautifully said. KP did say, sorry, Bo, I will ask you a question next week.
Hey, I love it. Thank you,
Just so you know. But
No
KP, thank you for the
He
question.
wasn't offended. Let's face it. It takes a lot more than that to offend Bo.
It was funny. But no, these were some great questions. We will be back next week if you want KP or anybody else wants to ask some more questions live in the chat. Tuesdays at 10 a.m. is our time to live stream, chat with you, answer your personal finance questions, but it never stops there. Make sure you're subscribed there first so you get those notifications about Tuesday at 10 a.m. Central, but then head to moneyguy.com because we've got our entire archive of episodes on all kinds of personal finance topics, some that we've covered today, along with our free resources, calculators, downloads that are going to just help you go a step further and go deeper and continue to get answers that you need so that you can just focus on what really matters and not so so much about the stress part of your personal finance journey. So that's what it's all about. We always appreciate you being here, and this was fun. Great questions today, guys.
Nobody's going to see this, but I figured I'd share one more little story. I was down in Orlando last week with some couples, and I had somebody, and I'll tell you why I'm telling this story now. I had somebody come up to me at the gift shop at the Haunted Mansion, and I was wearing my Great Big Beautiful Tomorrow shirt. You know, any of you guys know I'm a big Disney buff. And he goes, "Hey, my favorite podcast." I was always saying that saying.
No.
And I was like, "What's your favorite podcast?" And
No.
he goes, "The Money Guy Show." Now, what I couldn't tell,
That's
because he
actually a
said
good start.
podcast. He
No,
did not say
surely he knew.
YouTube. He said
Surely he knew.
podcast. He did say podcast, so he wouldn't know what I look
I
like.
mean,
And I was like, well, that's actually me. And I was like, thank you for actually saying
100%
something.
setup.
He
knew.
knew who
He
I was.
had
I
You
to
think
think
he
know.
knew
so,
who it
because
was?
both of your faces are on the audio podcast artwork.
Okay, then maybe he was playing it
Granted,
the
he
coy
might not
way.
know your
but,
mannerisms, like, you know, he doesn't watch you.
But all that to
That's
say
funny.
is I can't help as you were giving the closeout there is it's that key point that just always rings in my head is that what small decision are you making today? Because that's where it starts. Just the small decisions will help you build your great, big, beautiful tomorrow. I'm your host, Brian Preston, Mr. Bo Hansen, Money Guy Team, out.